can there be a step down in basis for inherited assets?
A step down. So let's talk about the step up first, because that's what most people are familiar with.
Yeah,
So
that's
step
what we
up.
always refer to.
Yeah, I buy something for 10,000. It's worth 100,000. I pass away. My beneficiaries get that. If I would have sold it, I would have had a $90,000 gain. They get a stepped up basis to current value. Theoretically they sell it on that same day, or sell it at that same price. They would have a step up to $100,000 cost basis, which means no tax.
So essentially what happens with inherited assets is the basis moves to the market value when the person passes, a day of death, essentially.
Right.
And so let's say you have an asset that you bought for $100,000, but the market value is only $40,000.
Yep.
Unfortunately, the basis will go to the market value of that $40,000 on the day of the death, rather than keeping that 100,000. So you can't really pick and choose if it's beneficial or not to change the basis. You only get that day of death, essentially.
Yeah, so it's going to change either way.
Yeah.
And so you basically would have lost that ability to write off that $60,000 loss that you had.
And so most of the time we never run into this, because a lot of times that when we keep assets for a long time is because there's a taxable implication if we sell them.
Right.
But let's say you have company stock, you love that company, but after you retire, the company hasn't done so well, but you don't really need the money, so you just keep it for sentimental value. What you could do with it is you could, if you know that you're kind of nearing the end of your life, or you foresee that, you could then gift it to whoever you want to inherit it. So if you gift it to somebody, they maintain that basis. And so if you go above the gift tax, I think it's 18,000 for 2024, you would go into your lifetime exemption, which is kind of the same as your estate tax. They kind of have this same kind of benefit together number that they use.
Yeah, I'm a big proponent of trying to harvest losses pretty much on a regular basis. If you love the stock, still think it could do really well, and you got a big loss in it for some reason, maybe you worked there a long time ago, you could sell it and buy it back in 31 days and capture that loss and still have the stock. Right now, you might have the stock move dramatically in that 31-day period. That's the risk. But if I put 100,000 into something that's now worth 40,000, I could capture that $60,000 loss and buy back the stock and be in the same spot. I still got $40,000 worth of stock, but now I get to write off this,
loss,
$60,000 loss off of my tax return year after year until I use it up. I can write that off of gains. So it allows me to get $60,000 worth of gains someplace else, or even in this stock if it happens to come back.
Yeah.
To be able to use that. So it doesn't have to be a planning process in terms of hey, end of life type of thing. You just do it regularly. Capture losses, capture losses, capture losses. We do it all the time. And because not every investment we make or anybody makes money all the time. But you're right. The ones that do are the ones that we keep. Like, for example, we still have, in March 5th, 2020, the market was dropping so fast, we didn't have a chance to really, do anything defensive. So we started taking a look at what was holding up the best. And Apple and Microsoft were holding up well, mainly because they're kind of like safe plays, right? They make so much money, they have so much money, and they have such good name recognition. And so we have clients that still have, those shares because we bought them in, taxable accounts. Happily, actually, it's still done well and still continue to do well for the most part. But those ones that are at a loss,
it doesn't have to be stock. It could be other assets that maybe are a little bit more illiquid too. So, and maybe it's harder to sell, but you want to make sure that if it does sell for below market value or below what your cost basis is, you could gift it to them. So it could be some sort of collectibles and stuff like that if you have records of that.
Yeah, I do have one client that has a fair size net worth and what have you, and is actually gifting appreciated stock because his tax return, his tax rate is higher than the people he's giving the money to. And so they can sell it and pay the tax, and he just gives them enough so that they're able to pay the tax too with the differential. And so you can go either way with that, but yeah, it's not a bad idea. If you have a negative and you're going to gift, they get to keep that negative. They could take that right off. So that's good. Yeah, it's a good question. It's really interesting. It does go both ways. You can you basically mark it to the date of death on all assets, whether it's a gain or a loss.